We have stubbornly high interest rates. We still have inflation going on, though it's come down somewhat. And we seem to still have high real estate prices. What's going on in the real estate market? Today, we're going to discover what actually is happening, what we can kind of project happening. And I have a very special guest, been on before, Jason Hartman, my good friend, an expert in real estate, and particularly residential real estate. Jason, always good to have you on the show. Welcome.
Hey, Tom, it's great to be back with you. It's always good to talk to you and your audience about the market and hopefully provide some good insights for them. For those watching on video, my background is very different than usual because I'm at my mother's home, and I sold my home about 3 weeks ago and became homeless, maybe the richest homeless guy you know.
Nice. Almost isn't always bad then. Just for those of our listeners who don't know you, Jason, just give us a little of your background.
Yeah, sure. But just to finish that thought, I'm spending the summer in Europe, so I'm not going to worry about buying a house until I get back. Anyway, I've been in real estate business all my life. I got my license my second year or in my first year of college when I was just 19 years old, going to Long Beach City College in Southern California. And I really got into real estate because I was interested in investing, but I made quite a nice career out of the brokerage side as well. And I've always been brokering real estate for clients and investing myself for my own portfolio. And, it's just been a fantastic ride. I always say that income property specifically is the most historically proven asset class in the entire world. And even on a down day with real estate, because of its multidimensional characteristics, it performs much better than most people think. And basically what I do now is I run a company called Empowered Investor. We help people buy properties and build portfolios of residential single-family homes in different parts of the country in markets we research, recommend, and with teams we recommend. So we kind of operate as a referral network or a matchmaker in helping people build their portfolio and provide ongoing support and software to them.
Awesome. So last time we spoke, was, I think, 2022. Inflation was really at a very high level. It's come down since then. We just got recently a report that it came down a little bit. It was kind of gone up and down, up and down. At the same time, the real estate market hasn't seemed to come down quite with the rest of inflation. In fact, there was an article in the Wall Street Journal the other day that was talking about how rents have actually kept one of the things that have kept inflation persistently high.
Yeah.
Can you kind of like talk about where the real estate market is right now as far as pricing goes?
Yeah. Absolutely. So, it is amazing to most people, all the doom and gloomers and what I affectionately call the crash bros, who have been predicting real estate market crashes during the COVID era, before COVID, post-COVID, et cetera, et cetera. They have been pretty amazed that prices have continued to rise, even in the face of the cost of mortgage money, depending on how you count it, virtually tripling. I mean, it's truly shocking to most people. And I'm going to share with you, Tom, a chart that really shows you why they got it wrong. And they got it wrong mostly because they were focused on new entrants entering the market and housing affordability. Now, in most cases, that would have been a pretty good predictor about the market. But in this case, it wasn't, because there was a big difference this time. And I'm going to share that with you. But to answer your question, prices have continued to rise, even in the face of much higher mortgage rates. Rents have continued to rise, even in the face of everything that's going on in the economy. And what we have is we basically have a systemic housing shortage, especially in the entry-level market. And it's a little bit hard to parse that and segment that, but just remember, the old saying in real estate is all real estate is local, but it's not just local. That's true. In a country as large and diverse as the US, there are almost 400 metropolitan areas. There are over 3,100 counties, over 9,000 cities. and according to Barack Obama, 57 states. But that's another another point. Um, and and so it's a diverse market. But you also need to segment by price range, by product type, by neighborhood. So it gets very granular, and it has amazed most people that the prices have continued to rise.
All right, well, let's go right. I know you got some slides for us and you got some charts, and we love looking at real numbers. So show us some real numbers.
Yeah, absolutely. Absolutely. I love showing the data and the charts and the graphs. And so let's go ahead and go into that. And here we go. Okay, so this is a chart that basically shows the payment to income ratio on a mortgage payment. What percentage of what percentage is that mortgage payment of your overall income? And as we saw higher rates and already highly appreciated properties, we saw this percentage skyrocket. And we saw the housing affordability index, which normally is a pretty good predictor of things. We saw the housing affordability plummet to the lowest point, the worst point in 4 decades, 40 years, with the most unaffordable market. And so, what all of the economists out there and all of the people who just totally got it wrong, Tom, what they focused on was this part of the chart where that payment to income ratio was way out of whack and housing was very unaffordable. But the mistake they made is that this only applies to new people entering the market. Now, as interest rates skyrocketed and prices were already very appreciated, sales volume dramatically reduced.
Sure.
We have about 140 million housing units in the United States. And housing sales, when they're going at a good clip, might be somewhere in the neighborhood of about 6 million sales per year, 6 million transactions per year. That went down to just under 4 million per year. So it was a big reduction. All the realtors, lenders, mortgage people, title people, they were all complaining like crazy because volume was way down. But what does that really mean? Well, since the rates went up about 2 years ago, only about 8 million homes have transacted, a low number in the overall scheme of things. That means that 132 million homes, in other words, all the people that control the inventory, they didn't transact. And they didn't want to transact because they had such a good deal. Those people were extremely comfortable with their low mortgage payments or having no mortgage payment at all. Let me give you some numbers on that. 25% of the country has a mortgage at or below 3%. 65% of the country has a mortgage at or below 4%. And 42% of the country has no mortgage at all. They own their home free and clear. The one thing I have always said, Tom, is that if you want to have a real estate crash, there is one absolutely necessary, mandatory ingredient that without which this ingredient, you can't have a crash. What is that ingredient? It is tens of millions of distressed homeowners who become millions of distressed home sellers. And we have the absolute complete opposite of that now. So on this next chart, we're looking here at all of those people, those 132 million people. Just a moment. Sorry, just to edit that. My dog was squeaking his toy, her toy. Okay, so you have all of these people that are extremely comfortable that bought a home or refinanced a home during the low interest rate period during the COVID era. So if they already owned, they refinanced. If they didn't own, they purchased and they got those super low rate mortgages. And as such, they're extremely comfortable. They don't want to give up their good deal. And
right. So they have no need to sell.
Right.
They could sell. I mean, even like take baby boomers like myself. Okay. So why would you sell? And this is, I was reading about this in the Wall Street Journal recently. Why would you sell your big house to get into a small house at the same amount?
or higher. The payment
Right.
might be
It
higher on
makes
the
no
small home.
sense. So,
Yeah,
so people are just, I mean, you used to have all of this movement. I'm going to downsize. Well, you downsized so that you could actually bank that money. That's
right.
why somebody who's retired downsizes. But if you can't bank the money,
Right.
why would you downsize?
You are absolutely right. And that is called the lock in effect. So we have this sort of poison pill, as I've called it, that the Federal Reserve put into the housing market. And I say poison pill, but that could be good or bad depending on which side you're on, right? We have all these people that just won't sell. They control the inventory. So just to kind of put a bow on this point I'm making, 8 million people entered the market since the rates went up. They bought a house. They have an entirely different situation than the 132 million people that control the existing housing stock. And that's why all of the economists, all of the crash bros, all of the doom and gloomers, they all got it wrong. They thought prices would crash, but they weren't looking at the people that controlled the inventory. And that's who matters. The 132 million people matter, not the 8 million that
Okay.
entered the market.
So this is single family homes we're talking about, right? So let's if we can. So multifamily, that's a whole different story, right? Because they don't have that fixed interest rate, and that we're starting to see come down.
Yeah, that's a different situation. So what happened in the multifamily market is very different. Uh, when the money was cheap and they knew there was a housing shortage overall, a lot of investors went and syndicated properties and piled into multifamily properties, apartment buildings.
Right.
And what they did is they bought those buildings with cheap money. And a very common scenario for them is to get a short term loan and to rehab and re-tenant the properties
Right.
and raise the rents, hopefully by about 30%. And that model works if you have long-term money or if the
Right.
money stays cheap.
Right.
But it didn't. The money got
Right.
dramatically more
Right. So
expensive
so
and
they
needed to
basically
come.
got cut up just like people in 2007, right? I mean, that's to me, 2022, 2023, we're 2007 all over again, except instead of in the single family home market, because there were all those adjustable rate mortgages in 2006, 2007. People didn't do that in 2022 on their personal residences because they could get long-term loans at 2.5%. Why would you go to a short-term loan for 2%? Makes no sense. The difference isn't enough. Whereas the people in the multifamily, they got caught basically with their pants down. Because who knew? I mean, frankly, who would have ever thought the Fed would raise the rates that fast? I don't think anybody could have predicted that. But let's talk about those rates. So even though clearly inflation has come down, and it's been very consistently down for 6 to 10 months.
Yeah.
Right. It's been down that 3+% range.
But it's
right?
not at the Fed's target 2% number.
It's not at their target, but it's at 3+% range. So, and the Fed's actually even talking about moving their target to 3, right? So they're talking about doing that.
Just when you can't achieve the goal, just change the goal.
Just change the goal. Exactly. But the question is, so are they just so fixated, and do they think that they have so much power to bring inflation down that they're not moving the interest rates down?
Yeah, it's a different world. The Fed is in a very tight spot, and they really can't fix it, at least not easily, because what they've got, what they're commonly playing is something called the Phillips curve. And the Phillips curve is largely the relation between inflation and unemployment. Okay. And basically, when you raise rates and tighten the money supply, you usually increase unemployment and you depress or decrease economic activity. And you do the opposite when you loosen the money supply and lower the rates, right? So that's what they're playing. And the problem is, and I'm very critical of the Fed, their response to COVID was legitimate initially. And then Jerome Powell was stuck on this idea of inflation is transitory. We heard that
Right.
transitory word a lot. And initially, he was right, but he just kept with that narrative way too long. He should have increased rates more slowly and much sooner. And then the inflation beast wouldn't have roared the way it's
Yeah,
roared.
but
And,
I
and
would add another thing, Jason, and that is that so all of this excess money that the government, it wasn't the Fed who put the excess money in the market, it was the government that put the excess money in the market. And they put it in through the American Rescue Plan and the Trump one before that.
right.
You know, the CARES Act, I think, was needed. That actually worked. But after that, wasn't really needed anymore. So it's like, okay, we're gonna we're gonna hibernate for 6 weeks, and then we're gonna be good. We need that stimulus during that 6 weeks. All good, but after that, we didn't need the stimulus anymore because we weren't hibernating anymore because humans can only hibernate for so long.
Right.
And but what happened is that these modern monetary theorists, what my wife likes to
MMT.
call magic money,
Yeah.
magic money theory, said, well, look, we can just print money. It's no big deal because under their theory, and if you read their books on it,
Yeah. I've
under their
interviewed
theory,
all the modern
it's
monetary
easy because you can
promoters.
put it in, but here's what you have to do. As soon as it starts getting out of control, you have to tax it back.
Right.
Okay. Nobody is willing to tax. In fact, we hear President Biden constantly, well, if you make less than $400,000, we're not going to raise your tax rates. Well, that is the opposite of actually what modern monetary theory suggests.
Right.
Because modern monetary theory would suggest that the consumers, who are the people making $400,000 or less, they're the consumers, okay, that they're the ones that you have to tax because you need to pull that money back out of the market. The Fed's trying to do, I think, all of the work with only half of the ammunition. They don't have the other half, which is the taxation half of the ammunition.
Yeah. The Fed controls monetary policy. The government controls fiscal policy. So exactly. They can't cycle those dollars back in because they don't control the taxes, right? So you're absolutely right about that. And let's examine, Tom, if we can, this subject of interest rates, because what I'm about to show you will probably blow your mind and definitely blow the minds of some of your audience. I shared this on my show before, but it's the first time here, and this is going to amaze you. Okay, so here it is. Let's just take a look here. Okay, so at the beginning of the year, just a few months ago, Fannie Mae, the biggest mortgage player on planet Earth, predicted that by the end of this year, mortgage rates would go to 5.6%. I have news for you. That's not going to happen. I mean, it's extremely unlikely because the Fed is sticking with their higher for longer policy. And they are just really stubborn about lowering mortgage rates. Now, that might well happen by maybe the second quarter of next year, but I don't think there's any chance we're going to see that this year. I do think we will see maybe 2 cuts this year, but again, it's going to be a slow thing. But the question is not when the cuts will happen, because that's not up to us. None of us know. The question is what will happen when the cuts happen, and the cuts are definitely coming. We just don't know when. 5.6%, that was the magic number that Fannie Mae expressed. And I do think we will ultimately see mortgage rates settle somewhere in the fives. But let me tell you, folks, I can do a much better job predicting supply and demand and inventory levels than interest rates, because interest rates are centrally planned and they are extremely hard to predict. That's my disclaimer, okay? But let's just look at the housing market like your kitchen sink. So if everybody visualizes their kitchen sink for a moment, and they visualize the faucet as new inventory or new listings coming onto the market. Right now, that faucet, it's on, but it's a trickle. There's not too many new listings coming on the market. There are more than a couple of years ago, but it's just not that many. Still, the supply is short because of the lock-in effect. We talked about that. Let's look at the basin of the sink. The basin of the sink is the existing inventory that's already on the market. Right now, that stands at about 550,000 homes for sale in the United States. Now, compared to what? That's out of about 140 million homes in the housing stock. So we have well less than 1% of the inventory for sale. That's extremely low and extremely rare. So the basin of the sink is 45% full with water. If it were at the top, at the rim, we'd call that a normal market of 1.2 million homes for sale. It's only 45% full. Now let's talk about the drain. The drain represents the buyer demand. How many homes are being purchased? What is the absorption rate of the new inventory coming out of the faucet and the existing inventory already in the basin of the sink? Since we saw the interest rates go way up, that has caused what's called demand destruction. And the demand is most definitely lower because affordability is so low. So what does that mean? Well, the drain is plugged up. It's about 20% plugged. It's still 80% open. People are buying, okay? But it's less than before. So that's where we are in the market. That's a good metaphor. So here it is. We started the market with just about 500,000 homes for sale, or started the year, I should say. Okay, about 500,000 homes for sale. Normal inventory being about 1.2 million. So inventory is still extremely low. Now, since then, it has increased. We've got just over 550,000 homes for sale now, but still that is well below normal inventory, and it's 450,000 below 2019 and 650,000 below normal. Okay, so I hope that gives everybody a good point of reference. Thoughts or questions on that?
Keep going.
Okay, this is going to blow your mind. This is the mind-blowing chart. We did some research. We have an economist that works for us. I gave him an assignment, and I said, we have got to know what is going to happen to the housing market when we finally get the Fed pivot, when we finally get the rate cuts. What will happen? So what I said is, I said, let's start with a baseline mortgage rate of 7%. We have to start somewhere. So we're going to pick 7%. So at 7%, 55 million people can afford a home. But if rates drop by half a point, 50 basis points, that means another 2.8 million people can now qualify for the median price home.
And Jason, what's that based on? So what percentage of income?
Well, it's based on the Fannie Mae Freddie Mac guidelines, which, you know, they've got a front end and a back end ratio. And by the way, I did another interesting research project on that. I'm a complete nerd. I love to do research like this, because what I was hearing a lot, Tom, is I was hearing people say, well, the elephant in the room, Jason, that's going to cause the housing crash is unemployment. We're going to see massive job losses. And they talked about the tech companies and the layoffs there and that kind of stuff. But here's what's interesting. The tech companies still net have way more employees than they did in 2019, even after the layoffs, okay? So the net effect is still more people are employed than they used to be, okay? So that's that. But let's say the doomers are right. And let's say we do see unemployment increase significantly. I mean, look, the Fed has stated that their goal is to increase unemployment.
Right.
That's the Phillips curve, because that would bring down inflation, right? Wages are spent into the economy. When people are employed, they have more money, and that creates an inflationary pressure. So let's say that happens. Well, I got on a Zoom meeting that I recorded with one of our lenders, and I said, Joe, I want you to open up the qualifying software you use to underwrite a loan. And I want to assume that you have a borrower, a husband and wife borrower, that are on unemployment. They both got laid off from their job. And they have a car payment and a student loan and some credit card debt. I just put together kind of a nice normal picture of what a typical American borrower looks like. And even with unemployment insurance, Tom, they could qualify for the mortgage they already have. Remember, 132 million people are extremely comfortable. Only 58% of those 132 million have a mortgage. And if unemployment increases for those people, they could still afford the house they already have according to their front end and their back end DTI, or debt to income ratio. Now, if you're unemployed, a lender's not going to give you a new loan, obviously, right? But that's not what matters. What matters is, can they afford the home they already have? And they can. It's
Right.
just so affordable.
Right.
So
So they're not going to dump their home.
they're not going to dump their home, because remember, that one ingredient we must have for a real estate crash is tens of millions of distressed homeowners who become millions of distressed home sellers. Okay, we just, there's just no data to support that that is going to happen anytime soon. So if you're holding your breath for a real estate crash, don't hold your breath, because it's just extremely unlikely. And for all the folks that like to, troll me and say I'm wrong, show me some freaking data.
Yeah.
Okay. You can't show me any data, right? And they have their opinions, and really they're the people that just missed out, and they're just upset, right? So anyway, at a 1% drop down to 6%, 5.4 million new people can afford a home. If it goes to 5.5, Fannie Mae's prediction, 7.7 million new people can afford a home. I want to remind you that the existing inventory is about 550,000 homes. Yeah. Imagine if only a third of any of these numbers enter the market and start bidding on homes. Just because they can afford to buy a house doesn't mean they're going to buy a house, right? So say here, 1 million new people enter the market, or here, 1.5 million people enter the market, or here, 2.5 million people enter the market. In a market with only 500,000 homes for sale, what do you think is going to happen, folks?
The prices are going to go up.
They're going to bid the prices up through the roof again. And, they're the only solution to this. It's simple, but the most basic law of economics is supply and demand. We all know that. The only solution to this is to dramatically increase the housing supply, to build more houses. That's what is needed. Now, of course, all of this stuff does vary with local markets. Of course, I know that. I've been doing this an awfully long time. I get it. We do business nationwide. We study individual markets. Everything we've been discussing is a national overall picture. And that picture points to a very significant housing shortage. By the way, a recent report came out that said home prices have increased in the first quarter of this year in 96% of all the metros in the country. Okay. So they're still going up. And until we solve the shortage problem, that's likely to continue.
Yeah. Supply, demand. All right. This is awesome data. I want to kind of fast forward a little bit. What do you see? I want to look forward. You talked about, you think that we could see those interest rates coming down next year. Probably, maybe actually a year later than people originally thought they would come down, which I think is going to have a enormous impact, more impact, obviously, on the multifamily housing market, because those people are hanging on by a thumbnail.
Oh, and, yeah, they're in trouble. No
compared to, right, because they've got this high mortgage insurance, or interest caps, cap payments that they've got to do. So if so interest rates come down, we've looked at that. What happens from a political standpoint? How does the election play on this at all?
Well, it's hard to tell. I mean, the Federal Reserve, our central bank, the largest central bank in the world, claims that they are not political, right? And they're not influenced by politics. But I would say that Jerome Powell skews to the left politically, if I had to say that. I don't think he's Trump was trolling him heavily. I don't think he likes Trump very much, but who knows, right? And it's not really one man's decision. It's a committee, okay, made up of all sorts of people. But you tend to see, and I can't say I'm an expert on this, but just my impression anecdotally is you tend to see stimulative effects and looser money happen near elections. that, they want to sort of make things look good. And,
Well, yeah,
there's
I
a
mean,
lot
it's
of
like
leverage on it.
forgiving student loans, right? I mean,
Yeah, that's
that's
handy
the
too. Yeah,
stimulus effect, right? I
right.
mean,
That's a way to
I
buy
love
votes.
that. I love that we're working so hard to combat inflation, but we're going to forgive student loans. I'm going, all right, we're at cross purposes here.
It's absurd. Yeah. It's not fair at all. I mean, imagine a blue collar worker who doesn't have a student loan is now essentially paying for the
Right.
student loans
Yep.
of a lawyer who makes
Yep.
twice as much as he does, right?
Yep.
It's
Yep.
completely
Oh, yeah,
unfair.
yeah,
Okay.
yeah, for sure, for sure. But also interesting here is one thing that so Biden's talking about raising taxes. So we were talking about the tax effect because that has a big impact on inflation. And if inflation comes down, then interest rates come down. So I don't think you can eliminate the tax discussion from the interest rate discussion.
I agree.
Whereas the Republicans and Trump clearly want to extend the 2017 Tax Act, which would increase the housing supply. Frankly, it would definitely increase the housing supply because of the stimulus to housing that the 2017 Act was. But at the same time, presumably it would also stimulate inflation because you're talking about putting more money back in the market.
Yeah, no question. These things are multi-pronged, obviously, but I'll tell you for sure, housing is very sticky. So it takes a very long time to create new housing supply. And that's just the reality of it. Okay, my mom's in the shot here.
That's awesome. Great.
Yeah.
Great. Okay, so let's kind of wrap up here, Jason. And 2 or 3 things that you would suggest entrepreneurs, investors do, given what's going on in the market with interest rates.
Yeah. Well, I would suggest that they be invested in the market. Because look, market timing is a fallacy. It doesn't work in any asset class. There are millions of studies on this. It's been proven over and over in a million ways to Sunday. But also remember that income property is a multidimensional asset class. And as such, it's not about prices going up or down. There are a lot of ways to make money with income property. Okay, so it's multidimensional. So, these people looking at this very shallow thing of our price is going to go up or down, that's just not enough information. Okay, I know lots of people, including myself, who have made a lot of money in markets that are sliding downward. Okay, there's many dimensions to it. Don't have time to explain all that. Watch my show for more on that. But you should be in the market. And for sure, that if you keep your money in cash, inflation is destroying you. It is absolutely ravaging your cash. If you have debt, if you have mortgage debt, inflation is paying it off because you pay it back in cheaper dollars. If you have savings or stocks or bonds, inflation is eating away at those. So you want it to eat away at your debt, not your cash. So that's an important factor as well.
I love it. So where do we find more about you and your show?
Yeah, so I host the Creating Wealth podcast, which has been going for 20 years now. It's one of the oldest real estate podcasts out there. I also, of course, have a YouTube channel. Just look up Jason Hartman on any podcast platform or on YouTube. And also check out my website, jasonhartman.com. And Tom, thanks for having me again, and happy investing to you and all your listeners.
Yeah, I appreciate that. And, this is such important information because while we can't time a market, we still have to understand what's going on in the market, right? Because even when we're applying fundamentals, those fundamentals are impacted by the market. And so we do have to understand it. And as we understand it better, we listen to people like Jason on real estate, and we get more of our own financial education, not just the basics, but also, the current, what's going on in the world. What always happens is we make way more money and pay way less tax. We'll see everyone next time. Thanks.
And that's the goal.
This podcast is a presentation of Rich Dad Media Network.